Good afternoon. It is Monday, January 15th, 3:30 p.m. Markets are closed today. Have a few things I want to discuss. When we left off on Friday, gold was up about $15. Okay, and it hit my key level of 1340. And I've been watching this level for quite some time. A few years, okay, to be precise. And this has been my key level. Now, there's a lot of people that already want to pop the champagne, okay? I'm hearing it. I'm seeing it. This is it, you know? No, it's not. It's not. Because these ranges can be rather large. And I'm not about to give the all clear signal, okay? So if other people want to think that this is a walk in the park and it's just going to take out 1340, okay? No, I told you on Friday, this is like the Battle of Shiloh. This is like the hornet's nest, right? At these levels. Now, I was watching gold today, and it was trading today, and you could see by the action, they're not going to let it take out this 1340 without a fight. Okay, this has been my key level for several years now. Okay, now I'm looking at a chart here. All right, I don't want to start talking about how high gold could go. Okay, because that's premature. I want to talk about what's now I believe is good support. Okay, if you look at this chart, okay, now this is a 5-year chart, all right? It's got that low of about 1050 in late December 2015. And since then, I mean, we're up to basically $300 from that low, all right? So here's the chart, all right? Going back 5 years, right? So we went down, we bounced around here. We went all the way down to that 1050. We made a big move up, and wouldn't you know it, we basically stopped. See that thick horizontal line at that 1340 line of resistance? We came down. We did not make a lower low. We did not make a lower low. So that was a very good sign. And we came back up, and once again, we hit resistance, right where we are now. We came back down. Once again, we did not make a lower low. So you would say, at first blush, we're in a bull market. We're making higher lows from that 1050 late December. Higher lows are clearly being made, okay? Now, I have that thin horizontal line. That's 1200. Which I believe now is very good support. If we look there once, twice, it held that 1200 level, okay? If we go all the way back there, you see the battle right there at 1200, both on the support and resistance. 1200. It held to 1200 there. 1200, right? Look at the horizontal thin line, 1200. Then we had a battle right there at 1200. Sometimes support, sometimes resistance. So to me, this is the key support. So why am I saying that? Because if you're going to jump in now at both feet, okay, which some people are doing, okay, your support, in my mind, is 1200. So your downside is 140 bucks, okay? That's your downside, all right? Now, let's talk about this thick horizontal line. Because this is why I say this is not a walk in the park here to get over this level. Because once we get over this level, okay, it's pretty much clear sailing. And they know that. The gold cartel knows that. All right, and they're going to throw everything in the kitchen sink to stop this. All right, so even though we've made higher lows, which is great, we have yet to really break out of this range that we have been in. And there it is. This has been a long range in terms of duration, and it's been a wide range in terms of price. All right. So I know people are getting very exuberant. All right. No, I said way back, for a while, for even much before the FOMC meeting in December, that I was salivating to get that rate hike behind us. Bring it on, I said. And they did. And since then, we've gone nothing but straight up. Now, they're doing all these, calculations and mathematical gymnastics about how many rates we're going to get in 2018. And the probabilities are already coming out. And I say the same thing. Bring them on. Okay? Bring them on. All right? But I'm not about, and as you know, I haven't even called this a bull market in gold. Okay? Because I believe there are some people that believe that we are in a cyclical bear market in a secular bull market. There are some people that still believe that bull market from 2000 to 2011 has only been temporarily postponed or put on hold, as we're in a cyclical bear market in terms of a secular bull market. That is not my position at all. As far as I'm concerned, and I've said it and I've been on record as saying it, the third time gold could not take out 1800, something was different. And we were in a bear market. And until I see this 1340 level taken out and held, I am still not calling a bull market in gold. Okay? I do not believe we're in a secular bear market I do not believe we're in a cyclical bear market within a secular bull market. I believe the secular bull market ended in 2011 when it third time 1800 failed. And since then, we've been in a bear market. That's all I want to say. Not to say that the price action isn't encouraging. The dollar is getting crushed. The euro is strengthening. The yen is strengthening. We need to watch that. All right? But I'm not popping the champagne. That's all I'm saying. So, I want to switch gears. Got some other articles here. But before I show you an article, I want to show you a picture. All right? These are the usual suspects. These are the usual suspects. Remember Casablanca? Round up the usual suspects? Well, here they are, people. The usual suspects. William Dutt. Take a good look at look at the smug faces on these individuals. Okay? These are the so-called masters of the universe, right? The uber arrogance of these people. That they think that they can calibrate this economy. That they think, right, that they can achieve their agenda from a junior year textbook using these models, okay? You got Dudley, Bank of Chicago, Evans, Bank of, I'm sorry, that must be typo. Dudley, one of them's from Chicago. I don't know. They're probably both from Chicago, okay? That's the way they do things in Chicago, right? Kaplan, Dallas, right? Kashikari, Minneapolis, Messler, Cleveland, Williams, San Francisco, right? Then you got, let's remember some of the old-timers, too. You got Greenspan, the maestro, right? These people don't ever go away. Even if they're not voting anymore, even if they're retired, they don't go away, these people. Bernanke, they write books, they make millions, they go, they give speeches, okay? They tell everybody how they save the economy. They never go away. Bernanke, green shoots, student of the Depression. Then you got your Lyle Brainerd, Board of Governor, Jerome Powell. He's going to be the new chair. Janet Yellen, the old chair. Out with the old, in with the new. Meet the new boss, same as the old boss. Then you got this Bullard, right? Bank of St. Louis. He kind of left, right? He got out of Dodge, right? But he likes to show his face on CNBC every now and then, right? These are the usual suspects, all right? Now, got some interesting articles. Because before an FOMC meeting and then after an FOMC meeting, they all come out, all right? They go all over the country and all over the world on the taxpayer's dime, and they make these speeches, right? And they like to give the impression that there's this big intellectual debate that they're having, when in fact they already know, okay? They already know what is the only thing they can do, and it's already been decided, all right? More and more Fed officials are beginning to think seriously about a dramatic change to monetary policy. More and more of these suspects, they're starting to float these trial balloons. They're starting to get it out there, okay? More and more Fed officials are beginning to think seriously about a dramatic change to monetary policy that would revise or even scrap its current flailing 2% inflation target. Economist Larry Summers notes that the Fed typically has lowered interest rates by 5 percentage points over time to stimulate the economy in recessions. Okay, so when they're in a recession, on average, they lower the interest rate, right? 5 percentage points, right? But it doesn't have 5 points now. It doesn't have 5 points now, right? What is the Fed mandate? Stable prices, right? And maximum, however they define it, employment, right? Stable prices, maximum employment. That's their dual mandate, right? So when there's a recession, they lower rates. And typically they lower them 5 percentage points, right? But the Fed, they don't have 5 percentage points now. Okay? That's why they're raising rates now. Not because the economy is good, like CNBC wants to sell everyone. Well, the economy, we're growing, so we can raise rates and it's a good thing. No. They're raising rates simply because they need a cushion. Because when the next recession hits, they got to lower rates. But you know what? Lowering to the zero is still not enough. They're constrained by this lower bound. Okay? The solution gaining the most traction, and this is gaining traction, people, and mentioned by officials and academics, is called price level targeting. Okay? This is where it's going, you know. We need a bigger boat, right? We need a better model. Because they can't be constrained by this zero lower bound anymore, okay? Even while the economy and markets are booming, I don't know about the economy. The stock market certainly is in melt-up mode, and we'll get to that. Federal Reserve officials are worrying about how they'll respond to the next recession, which is right around this corner. And they don't especially like the picture they see. It's one where the economy starts contracting, but the Fed, still at low interest rate, has little ability to respond. It lowers rates to zero, but that amounts to only a fraction of the stimulus it has provided in past downturns. Once again, the Fed faces the quandary of what more it can do when it's at zero and can't cut any more, and it is forced to contemplate extraordinary, uncertain, and controversial measures like quantitative easing. This is like a rat hole, people. They are these usual suspects are taking us down a rat hole, and we're letting them do it. And we still bow to them, the maestro, Bernanke, the student of the Great Depression. It's mind-boggling. More and more Fed officials and academic economists are wondering if there's a better way and beginning to think seriously about a dramatic change to monetary policy that would revise or even scrap its current flailing 2% inflation target. The Fed has missed that target almost since it was implemented in 2012. They keep missing their inflation target, undermining its credibility in markets and possibly entrenching expectations that inflation will always run below target. Former Treasury Secretary Larry Summers, speaking at a Brookings Institution conference this week on the Fed's inflation target problem, urged the Fed to get moving on a fix. Get moving on a fix. He noted that the Fed typically has lowered interest rates by 5 percentage points over time to stimulate the economy in recessions. The Fed doesn't have 5 points now, so the next recession will find the central bank less able to kickstart growth, possibly enabling a longer, deeper downturn. The overwhelming likelihood is that when recession comes, policy will not have sufficient room to cut rates as much as it would like to within the current framework, Summers said. Quoting a recent research paper, Summers suggested the Fed could be at a zero interest rate 30 to 40% of the time in the future unless it changes its current regime. Zero interest rates 40% of the time, right? Unless it changes its regime. I am completely unconvinced that quantitative easing can be our salvation next time around, Summers said. So they're taking us down a giant rat hole. Okay, they're bringing on negative interest rates. They're going to come up with helicopter money. There's going to be price targeting. There's going to be maybe nominal income. Everybody makes $19,995, right? You'll get your basic housing. All right? You'll get a mode of transportation, public or private, to get to your job. Okay? This is where it's going. The handwriting is on the wall. I'm 17 minutes into this video, and I ain't even scratched the surface yet. Because I got a whole list of what these actual Fed heads are saying now. This was Larry Summers, a quote-unquote economist. All right, we'll have to table this, people. I'll finish this article up. The recent tax bill, which boosted the deficit outlook, means the fiscal side will have less ability to respond next time around as well. This tax bill, it's just more and more debt, more and more debt. The solution gaining the most traction and mentioned by officials and academics is called price level targeting, and at least 3 Fed officials in recent weeks have talked about it, though with varying levels of support. Currently, Fed policy calls for the Fed to hit a 2% inflation target over time. It continues to shoot for that inflation rate even while continuously missing that goal. All right? Price level targeting would ratchet up the seriousness of the effort. It would account for those past misses and prompt the Fed to aim for a higher target in the future to make up for its prior shortcoming. We can't hit 2% now, so in the future we'll make it 4%, right? We'll average down now, and this is mind-boggling that these people actually get away with this nonsense, okay? We can't hit 2, so in the future we'll make it 5, right? You can't hit a moving target, and that's all they'll do. The target will always move. We're data dependent. Okay, what's the data? What are you looking for? What's the criteria? When is it enough? When do the goalposts stop moving? They've usurped our whole economy. These banksters. They've totally usurped it. The price level target will keep rates lower for longer, San Francisco Fed President John Williams said at the Brookings conference. Williams has been among the most outspoken advocates of making the change. Over time, it hoped that a price level target would keep the Fed away from zero, giving the policymakers ammunition to fight the next recession. Ammunition. Don't let the business cycle play out. Don't let the free markets decide. No, we need ammunition to fight the next recession. This is a shame, people, that it's come to this. It really has. It's a sad day in the United States and free markets when this is what it's come down to. When you got a bunch of academic elite eggheads, okay, ruling the world. Well, we'll have to pick this up tomorrow, Lord willing. Got a whole stack here of things haven't even gotten to. But, Lord willing, we pick it up tomorrow. Beautiful day out there today. Plenty of sunshine. Cold weather, but very nice if you can get out. Dress appropriately. Take a walk. Tomorrow the markets start up again. And like I say, this 1340, the fireworks, I believe, are really starting to begin. So if you can get out, take a good walk, renew your mind, right? Your spirit, your soul, your body. And we pick it up tomorrow, Lord willing. Thanks, people. Ciao.